Welcome everybody. It's already April. This is the April Trading Club meeting. Here is James Helliwell and myself, Lex van Dam from the Trading Academy. A lot to get through today, probably be close to an hour and a half, 2 hours as usual. We have a lot of new members joining us this month, so that's absolutely fantastic. Let's quickly get started. What's happened in March? Obviously, like the end of we've had 3 months now. It's been a big quarter end in the equity markets. We've seen a lot of action. Markets have come off a lot and then they rallied again. So what do we see? What do you see here, James, when you look at crude?
Well, one of the things that we were looking at last month, in last month's meeting ahead of March, was a potential move from around $33 per barrel to towards 40, which indeed did take place. So summing up the month in a couple of charts, this was the key driver, I think, of trade this month across the market. So that was, in a chart, the month.
Okay.
In 2 charts, the knock-on effect that had in equity markets and, credit and subsequently equity markets was a reduction in volatility. So the VIX was essentially fell or reduced by a quarter. So the demand for put protection, downside protection in the equity markets, having been elevated for a number of months now, also subsided. So there's a little bit of calm returning to markets following a very turbulent beginning to the year.
Okay, yeah, I see it here. It's trading at a 1-year low, almost half the level that it reached in the midst of the panic boom in the middle of Feb. And it looks like there's a lot of complacency back in the market as crude rallied, as market stabilized. The VIX, which is a fear index, has come to the lower end of the range.
And because we like charts, to sum it up in 3, here we go with another. So we did see a rally in the S&P 500 subsequently to the tune of 6.5%, which was actually more than we saw we saw high yield bonds rally. They only rallied about 2% this month at the time of producing this, which is the final week of the month. But the interesting thing here, as we pointed out in other charts, is a crude rule of thumb, a monthly chart of the S&P 500 with a 10-month moving average as a gauge of kind of the major trends. Provided that nothing happens too extreme this afternoon on the 31st, it looks set to end the month above that, I would say, all-important rule of thumb. So actually, perhaps this is a return of, upside for the market. So just as a gauge, it's something which we keep an eye on.
Yeah, and obviously a lot has happened in the markets, and obviously a lot of global markets are off their highs. But if you look at the king of markets, the S&P, almost at the all-time high. So what's the problem, you would say?
High low as well. It didn't make lower lows on a monthly basis.
Agreed. What's really important to look at when you trade commodities and equities and currencies is what are other investors doing? Where's the money going? Because there might be a lot of negative news on something. If everybody's buying, then it's still very likely to go up. So as it's the end of the quarter, it's interesting to see what's happened so far this year. And let's look at the different asset classes, looking at the ETF flow into equities, in fixed income, commodities, currencies. And you can see here that the total assets in these different asset classes is now $2.1 trillion. So it's a lot of money invested in this. And so what's happened year to date? So there have been inflows. $27 billion has moved from cash into the different asset classes because they, cash you're obviously going to earn 0, and there's a lot of pressure for people to earn a little bit of money. So where has the money gone? Funnily enough, equities have seen outflows. So 13 billion has moved out of equities. It's only a percent of total assets, so it's not much. But what you can see here as well, money has gone into fixed income. So that's the biggest winner in absolute terms this year. Money into fixed income and commodities. The commodity ETFs have seen extra 10 billion of inflows. So the money has gone into fixed income, into commodities, and out of equities. That's my first conclusion here. So if you then look at the commodities, you can see here that the real winner has been precious metals. So of the 10 billion going into commodity ETFs. Precious metals have been the big winner, and that's mainly gold, like we saw last time, and like we will see again this time. So what's happened in the bond market? Where did all that flow come from? You can see here it came from US government bonds, it came from US corporates, and then what they call broad, which is sort of a mixture of the different ones. So that's where the money has gone into. So people are still buying government bonds and US corporates, which is, I guess is bullish. The one thing to understand here, though, is that there's a secular trend into fixed income ETFs. So there will be some of that. That has nothing to do with allocating money. It might have come from real bonds into ETFs, but still, this is what we see. That's what we see on this chart. And then this is an interesting one. This is within equities. Maybe James, you want to talk a little bit about this?
Sure. I think it's pretty clear here that the money has been flowing into emerging markets relative to the amount of assets, and specifically here Latin America stands out, although in absolute terms the inflows aren't as great.
But still, I mean, if you look at, for example, Brazil, best performing equity market today, currency has bounced year to date, so that makes sense.
Yes, I think money has flown to places of pain or prior pain as investors got nervous and bond yields went down because people were buying bonds, seeking safer assets. Within equities, it was really quite difficult to allocate money. It wasn't just simply a case of remaining long the US market and kind of getting a return. So we've seen money flow out most significantly of European equities, and also Asian equities. Now with the Nikkei's, perhaps not as surprising, but Europe surprised me a little bit there, given the stimulus and so on that we've seen.
Yeah, so you've seen, obviously in Asia, Japan, strong yen, bad for the Nikkei, and we'll talk about the strong yen in a little bit. And in Europe, you've seen a strong euro, and that hasn't been great for it. Interesting to see though that North America money has been flowing out of it, even though the S&P is back to the highs. But overall, this year money has flown out of equity ETFs, which is significant. So then last time we also spoke a lot about growth and value. Should you go for the cheaper stocks, cheap on a price earnings basis? Or should you go to should you be invested in the growth stocks, companies that are able to grow their earnings quickly, often at higher valuations as well? And what we've seen this year, as we expected, as we indicated last time, value is making a comeback, and that after quite a long period of time. So that's an interesting one. So if you invest and you are thinking of buying a stock, it's important to know if it's a growth stock or if it will be classified as a value stock. Because if you buy a stock that's a value stock, then you have a bit of a tailwind. Well, if you buy a growth stock, you're going to have a bit of a headwind. So that's interesting to know. And then we're looking at the different sectors here in the US, which have seen the inflows and the outflows. And again, it's really useful to have this in the back of your head, because if you know what other investors are doing, where the money is flowing, hopefully you'll make a better investment decision. And you can see here the biggest winner this year, where the most money has gone into, is utilities. $4 billion has flown into it, which is an increase in assets of 28%. So that's the big winner. The other big winner is telecoms, 17% additional assets. And the reason that these stocks have done so well, in my opinion, is in a continuous low rate environment where people are looking for yield in stocks. So they invest for dividends, for stocks that have reasonably high earnings yield, and then telecoms and utilities are the top sectors. And we'll look at it on the next slide a little bit more in detail how they have actually performed. Then if you look at the outflows have been in healthcare, and that is later on we're going to look a little bit at Valiant, a name that many of you might have heard of. Clinton has made some negative comments, and healthcare of all sectors was a real growth momentum sector, and that has completely turned around. So again, a headwind for that space. Financials, spoke about last time, how that is very difficult for these guys to make money in a negative interest rate environment. So that's not good for them. And then the other sector, consumer discretionary, again, had an enormous push, very high valuations, and now it's starting to see outflows.
Some big momentum names in there as well. If they've, former winners of last year, think the likes of Amazon, perhaps Netflix, some others, and also within IT or information tech, you've also got the likes of Google, which have performed relatively well, but you've got other names in there which will have come under a bit of pressure.
Yeah, and I mean, Amazon is down, 15% this year. Netflix about 10. General Motors, consumer discretionary, about 10. So there's definitely some selling going on. Obviously, on a longer term basis, these guys have still done extremely well, but money is being pulled out of those sectors. And here you can see, what has done year to date best. And here the money flow really predicted that utilities and telecoms are the top sectors. And if you look at healthcare and financials, they really have struggled. The consumer discretionary is up 1%. It's pretty much flat, but that's purely because last month it really made a bounce. So it came off a lot and then bounced back flat. But you would have been a lot better off being invested in utilities and in telecoms. So that's just a little introduction. James, what we're going to be talking about this month?
Okay, so first of all, we're going to kick off with an update on last month's trade ideas that we came up with. So it's all well and good talking about them for the month ahead. Of course, we can't predict the future, but it's also good to revisit them and get an understanding of whether the fundamentals may have changed, whether any new information has come to light in the meantime, and basically to have a run through how some of the ideas have worked out. After that, we'll be going on to some new ideas for the month. So crude oil clearly has returned to be the driver of global trade recently. And given the rally, it's had a knock-on effect into inflation expectations in combination with core CPI, which we'll look at in due course. We'll look at some ideas around the dollar, the US dollar, whether that may make a resurgence or whether interest rates are never going to go up, as it sometimes feels. Then some of our favourite trades around the reflation theme. So the idea that inflation may return and how you can trade those, not just through the usual sort of gold proxy, but also through the currency and even the stock market using an ETF. And then, almost last but not least, this is the big one for me this month. Could it be, or could we be near the end of the bear market in the Australian dollar? There's something going on down under, and we've got lots of good research this month looking at a little bit of China as well as the Australian economy, and there's some really, really interesting information in there. So for me, that's a key one. And then at the end, last but not least, a good reminder, Lex, from the course, that stocks don't go up forever, and the majority of them end up going bust at some point, and we've got a couple of fine examples, not necessarily going to bankruptcy, it's too early to tell that, but Valiant is one of them, and a couple more that we'll be using as examples.
Yeah, and the theme that will come up in especially in the Australian dollar side of things, is China, and we have some very interesting data on China as well, actually, that can be very useful in helping you make a decision if you think China is all over, or if it's actually not as bad as people think, because that will drive a lot of trades. And even Janet Yellen, this in her last Fed meeting, spent a whole paragraph talking about China, which was unheard of. So you can say that the Fed is watching Chinese data as much as American data now. So hopefully we can help you a little bit with that. So, but let's have a look at what happened with the different ideas from last month. James, were you happy with the ideas we had?
I think I don't know how to say this. It's probably we were lucky in the last month. It'd be too bold to suggest that we're always going to be right, but with the exception of, and of course the timing of these trades isn't necessarily the day that we put the idea out. It's information and not a recommendation to trade that instant. It's information for you to make up your own mind. but using the performance window between when the last club meeting was produced, I think it was the 26th of, that would be February for March time, and now that we're recording this on the 31st, having prepared it this week, if we look at the performance in that window for each of the trades that we'll go through, there was only the US financials trade, and that was mainly down to timing, that we actually saw a negative, or would have seen a negative return on had you have put these ideas on. So out of the 7 that we had last month, we had 6 winners and 1 negative return. So we're going to have a look at each of these and go through what's
perfect.
happening.
Okay, let's start with value versus growth.